In the world of finance, understanding the concepts of financial years and fiscal quarters is crucial for businesses and investors. These terms form the backbone of financial reporting, budgeting, and analysis, offering insights into a company's performance and its health. Let's delve into what these terms mean and why they're important in the realm of finance. What is a financial year? A financial year is a 12-month period used by businesses and other organizations to calculate their annual financial statements and tax obligations. Some companies may align their financial year with the calendar year for simplicity, while others may choose to start their financial year on April 1st and end it on March 31st of the following year. It allows businesses to track their performance over a consistent time frame and compare results from one period to another. Additionally, governments may use the financial year for tax collection purposes, with tax laws and regulations often based on this cycle. What is a fiscal quarter? Within a financial year, the period is often divided into smaller segments known as fiscal quarters. Each fiscal quarter consists of 3 consecutive months and serves as a way to provide more frequent updates on financial performance and progress towards annual goals. The 4 fiscal quarters are typically denoted as Q1, 2, 3, and 4. It also enables investors and analysts to assess a company's performance on a more granular level and make informed decisions about buying or selling securities. Why are they important? The concept of financial years and fiscal quarters are essential for several reasons. Number 1, financial reporting. Businesses use financial years and fiscal quarters to prepare and present their financial statements, which provide stakeholders with insights into a company's financial health and performance. Number 2, budgeting and planning. Organizations rely on the financial year and fiscal quarters to set budgets, allocate resources, and plan for future initiatives, while allowing a time to review their performance. Number 3, taxation. Tax authorities use the financial year as the basis for collecting taxes from businesses and individuals. Thus, businesses need to comply with tax regulations and meet filing deadlines. Number 4, investor relations. By providing regular updates through fiscal quarters, companies can maintain transparency and trust with investors who closely monitor companies' financial performance to gauge profitability and growth prospects. What is an earnings report? An earnings report is a financial document released by a publicly traded company that details its financial performance for a specific period, usually a quarter or a year. This shows how much money the company made, how much it spent, and how much profit it was left with. Here are some of the key things you will find in an earnings report. Revenue. This is the total amount of money that the company brought in from selling its products or services. Expenses. This is the total amount of money that the company spent on things like salaries, rent, and materials. Net income. This is the amount of money a company has left after subtracting its expenses from its revenues. Earnings per share. This is a measure of how much profit the company made per share of its common stock. It's calculated by dividing profit by the number of shares outstanding. Companies are required to release their earnings reports to the public. However, the exact date when a company releases its earnings report within that quarter is not fixed. Overall, financial years, fiscal quarters, and earnings reports are fundamental concepts in the world of finance, providing structure and organization to accounting, reporting, and planning activities. Subscribe to XDB to learn more about trading and investing.